I think that part of the move yesterday was because of fears that the market was closed today, and lack of access gets people a little bit jumpy. The bounce today is uninspiring. S&Ps are up about 15 handles. I'm going to put that in. I don't care as much about that because of the extenuating circumstances with the market closed today. But if tonight and tomorrow we don't have a decent bounce on days, after a 3.5% decline in the S&Ps, the likelihood of a day being higher the next day is up a little bit. 59% of those days were higher, an average of 53% of normal days being higher. So it's not significantly more, but it's a little bit more likely to bounce. If we can't bounce, that'll be troubling to me. The whole thing, by the way, Becky, is that the news of the Fed going more dovish that played out over the last 3 weeks, and then the China sit down, whatever we want to call it, those couldn't take us over the November highs or the mid-October highs in the stock market. That should have been a signal, and it was to me for a little bit of bearishness, not as much bearishness as we saw yesterday, but that should have been the signal, and I think it was. I still think eventually we're going to take those levels out because this story's too good to sit down, but we're just not ready for it yet.
Hey, Jim, just a question for you. You mentioned we'll be watching the futures right now, tonight, and then the market tomorrow. Futures, obviously, though, has much lighter volume. Is there anything we really can read into the moves that we're seeing right now?
No. I'm trying to read as much as I can, but I agree with you 100%. When it's a low volume day, even, by the way, yesterday, the big plunge was relatively low volume. You can read that in a couple different ways. If you'd want to see a high volume capitulation trade to think that we've genuinely trimmed the hedges and can go higher, but you can't read as much on the down move either. So either way, it's not as good a read. You mentioned the jobs numbers later this week, and I think that those numbers are always monumental, except for the fact that the job part of the economy, we still are conditioned to think, well, that's good, that's going to be fine. That's not really where our focus is right now. If something happened there and we didn't get good jobs numbers, that could be a big deal.
Jim, I was glad that we had last week. You know what I mean? Because the 800 points yesterday. If it was 800 points from the lows, or
that would have been,
or on the NASDAQ, if it was 300 points from the lows instead of 300 points from what happened after that, because it just gets us back to 25,000 on the Dow. The S&P stays at 2,700. Didn't get through Santoli's 2,800, but it didn't go through 2,550 either. So it was like, thank God for last week, or yesterday would have really, and with a closed market the next day.
Yes, but I actually think that those kind of things happen when you fail to make new highs, and they accelerated too. If that happened from the lows, that would be a huge deal. But by the way, there's a couple different markets where fairly significant line in the sands have been drawn. That $50 level in crude trade, we pierced through it twice and rejected, and the 2,600 level in the S&Ps, we've come down to there twice. If that broke and we stayed below it for a couple days, then I would think this could turn into something huge. But I don't believe that now. I think we're in range.
We definitely wrung out any complacency from the Powell comments and from the G20. We wrung that out yesterday, and we're still above the lows. So, we got the bearish mojo back without really having to hit new lows. So I don't know.
But something you just said is very important here. We had 10 years of very, very low volatility. I'm gonna, Joe. The volatility.
I didn't see that.
The volatility that's back is good in a couple different ways. One of it is that people were conditioned over a 10-year period to go further and further out the risk spectrum because rates were low and volatility was low. And people have to remember that, and now I'm switching from traders to average investors. People have to remember that there is risk in risk assets. And this year has served to remind us of that. So the investors that start to come back in 2019 will be more conditioned for that and more stable, and will be a lot less weak hand money, in my opinion. So I'm fine with this volatility, and it's good for trading.